Good evening, class, and welcome to our MI class for today. Um, Today we will be continuing from where we stopped last week, and seeing that this topic is very sensitive, and I don't want to rush it. I want us to take a little review of what we did last week on process costing. Process costing was the second leg of what we learned last week, Wednesday. So let's take a little moment to look at what we learned in process costing. Okay, so let me share my note now. All right, so here we have it. Let me start from beginning here. In process costing, we explained that I used the example of uh, a baton when you are running a race. I used the example of people who are running a relay to explain process costing. And I told us that process costing is different from job costing and batch costing and service costing, which we did last week. Now, one of the major difference is that job costing and process and batch costing are kind of special. Like job costing, we said is special, tailor-made for the customer. While batch costing, you do everything in batches. You do everything in batches, continuous in batches. Now, when we say process costing, we are talking about one process leading naturally to the other process. I gave you an example of how the processes in a bread manufacturing company works. Let me give you that example again as a form of revision. I said that in a bread manufacturing one from the other, that one of them leads directly to the other. Let's start with the first one. The first one happens to be the people who will take the raw material from the store. And when they take the raw material from the store, they now mix it. So we call them the mixing process. Now, when they mix the raw material, the flour, the egg, the butter, everything, they mix it from, they put it in a mixer to mix, they bring it out. It becomes their output. Now, that output needing it. Now, those kneaders, they will now take their time to knead the output from the mixers. So they knead it, they will now make it into fine dough. Now cut it, weigh it in a machine to look at the standard size that they normally do. Now, when they measure it and they get the standard size, they will now put it into a pan and leave it to rise. That putting it in the pan finishes their work. So that is their output. They got it from the mixer, change it to fine dough, put it in a pan. That's their output. Now the bakers will allow this bread to rise. When they allow the bread to rise and it is time to introduce it to the oven, the bread in the pan becomes their input. They feed it into the oven. After heating the oven up to a particular conserve time. Now, the oven is ready to heat it. They put it into the oven. The oven heats the bread and they bring it out. When they bring it out, that ends their job. There are some other people who will take over from and putting it into the storehouse, or I'll call it the cold room, where it will be left to cold because they will have to slice it. Excuse me. Because it will be left to cold so that it will be sliced. So those people will take over from the bakers as they are bringing it out from the oven. They are turning it in and making it to putting it in the storeroom to cold. When it has cooled sufficiently, the slicers will now come, take the bread and introduce it to the slicing machine. Slicing machine will slice it. They will now package it into the package and now put it in the finished goods store. And so you can see the process it takes from the raw material to get into the package, final package of the product ready to be sold by the stores. So if it is not yet in the nylon bag, it is still in work in progress. It is not complete. Although you can say that it is 95% complete, but as long as it is not sliced and put into nylon, it is not complete. Even the ones that do not need to be sliced, as long as they are not in the nylon, it is still work in progress. So you see the process, one takes over from the other, just like a relay. You run and give the baton to the next person takes it and give to the next person, take it and give to the next person. That is how you see process costing. Now, we said that process costing will see what we call direct materials. Direct materials and every other cost is called conversion cost. What do we mean by conversion cost? We say the labor cost and the production overhead. These two make up the conversion cost. So all the things you do to convert the raw material into finished goods is conversion. And so that's why we call it conversion cost. So we then go on to talk about the situations in which process costing might be appropriate. We saw examples include chemical manufacture of liquid, the continuous manufacture of high volumes of low-cost foods such as, like I mentioned, bread. Okay, then we now went to give you example of process costing account. And I told you that in process costing account, all your production costs, all the things that make up production are debited. So your production cost is debited, while the other things are credited. And I told you that some of the things that are debited includes material and conversion costs. Then the things that are credited is the output when you have put them into finished goods. We saw an example whereby it was so 100 units of the raw material gave us 100 units of the output. There was no problem as to that. That means the total cost incurred in the production, which you see in the left-hand side, which is 1,005, is being charged to the output 1,005. But life is not always like that, in the sense that you will see a situation whereby there is a loss. We gave an example of a soup. You buy 1 liter of soup and it costs you 1,000 naira. Okay, let's say you buy 1 liter of, you want to make soup or so, and it costs you 1,000 naira. Then it costs you 500 naira to convert it to whatever you want to convert it to. That's fine. Now, we said that because you are heating it, there is going to be some loss. And that loss, you ask yourself, am I going to apportion cost to the loss, or am I going to apportion it only to the output? So you have to ask yourself, how is the proportion am I going to share this cost, this 1,005, between the loss and the output? And why are you getting loss? We now also said again too that you can get a situation whereby you have spent 1,500 naira in making it as input into the production, but yet you find out that at the end of the period, not all the input has been converted to output. You still have some that are left unconverted to output. 10, like here is 10, and the output is 90. That is 90% of it is output, the 10% is work in progress. What costs are you going to apportion to the work in progress, and what are you going to apportion to the output? This is another question we attempt to answer. Okay, we now saw how we are going to deal with a closing work in progress. From one period becomes the opening work in progress in the next period. And so because of that, it's going to increase the production cost. So opening costs, opening work in progress, increase the production cost. Closing work in progress reduces the output. And that's what we did. We now went to see the pro forma. This pro forma should be your guidance. We said there's going to be a work in progress, opening work in progress, because that work in progress, it will have some elements of material. You must show the units that are incomplete, and you will show the value. Then the direct material, you are going to show how many units is that and the value. Then labor and direct labor, direct expenses, overhead, all these are called conversion costs. You don't need to show materials. You don't need to show units. Just show their value. We will talk about abnormal gain later, but we now went to good output. This good output is you must show the units allocated to it. Then we now said there may be a normal loss and there may be an abnormal loss. Forget about this good output they put here again. Then there is a closing work in progress. So the only thing that could not exist together is you might not have abnormal gain and abnormal loss in the same account. It's either two of them are absent or just one of them is present. So that is what we discussed. We then talked about normal loss. What do we call normal loss? Normal loss is the loss that you expect to make in the course of your production. Let's say, for example, you are distilling petroleum products and you find out that you are going to experience evaporation of your liquefied natural gas. And so you are going to give allowance for normal loss. So you may decide that out of the gas contract you are going to get, you may have maybe 15% loss. So that's it. So since there is a normal loss, if you're going to have 15% normal loss, that means you're going to be expecting to 85% of what you put in to come out. So we said our expected output is what we will use in calculating the amount to allocate to the good output. We now give an example here. The normal loss of a process is 10%. Company puts in 5,000 liters into the process, 10%, which is 500, will be lost. And so 90%, which will be 4.5 liters, will be expected. Then we said that at times the normal loss may have no recovery value. Why do we think so? This is because, let's say, for example, you made, you are trying to boil something. And if you are boiling a thing, there is going to be evaporation. There is no way that evaporation, when it goes, that you can value it. You are not going to recover that evaporation. Then that means there are some losses that you expect no recovery value. So what will happen is that all the inputs that you put into the production process, when you take cognizance of your expected loss, your good expected lab is smaller than what you are putting in, and that means that expected output will share that cost that was introduced into the system. And so you find out that your cost sorry, pardon me. My network, I don't know what happened. Some people will just be calling my line. Sorry. Okay, so let me share my notes again. All right. So we now said that the cost of is going to be your total process costs, all the things you put into the process, divided by your expected output. And what will be your expected output? Your expected output will be your input minus your normal loss. That will give you your expected output, which is your denominator here. So we now saw an example, and I said that, how do you know that you have no normal loss? You have normal loss, rather. When you know that you have normal loss is when your input is higher than your expected output. And I said that your expected output and your actual output are the same. It means it is only normal loss you experience when the expected output and your actual output are the same. And now we now said the normal loss is 10% here, which is 200, So we now see that look at the process costs. Are all these here 4,500, and we now said your expected output is 1,800 liters here, and when you divide it with the total cost here, you have 2.5 as your cost. So that is what you use in your preparation of your process cost. So I said before that your materials will be in units, and the value, your direct labor and overhead will just be in value. So the things here is total units 2,000, total value 4,500. You come and put the same thing here. So that means you must have done the left hand side first, and you put the same thing denominator down and the totals down. Then I said start, even though you put your output and your normal loss, start with the value of your normal loss. The value of your normal loss is 200. You calculated it, is simple, and it has no recovery value. So you just put dash. Automatically, it means the good output is 1.8. Simple as that. Then we now said there will be a time whereby they may have a recovery value. And I give the example of bread that got so overrized that it cannot be sold in the normal market because which kind of bread is this? Or maybe the bread is so underrized that it looks abnormal. Or maybe there is a burnt bread. Or maybe there are some bread that maybe insects would have eaten it where it was kept, and you cannot sell it to the open market. And so some people might want to buy it for scrap to make feeds for animal or to do some other things. Now, that means you have recoverable value. You will not be selling, you will not be disposing of the loss. It's not the kind of loss that, like evaporation, that does not have a recovery value. Even the other ones that is too rise, there are some people who don't have money. They want to come and buy it like that, so you can recover. So what you now do is that your cost of good output is now going to be total cost process minus the scrap, now divided by the expected output. That is how you get your cost of good output, which is what we see here. Using the same example here, there is a recovery value of 0.9 naira per liter. And you find out that since we have 200 liters that were lost, but it is recoverable, we recover those loss at 0.9 naira per liter, give us 180. So when we less 180 from 4.5, you now see that the good output is not bearing the whole brunt of 4.5. It is now reduced to 4,230. So you now see that it has now reduced to 2.4 instead of 2.5. So it has eased it. So we do the same thing we did here. The left-hand side, perfect. Go to the right-hand side, we do the same thing. Output and 100. What is the value of the normal loss recoverable? 180. So you just make the output as a balancing figure. Now, normal loss with cost of disposal. Now, we now said normal loss with cost of disposal. It means that you cannot recover anything from the loss. It means that the loss, you see, there are three different kinds of loss. The first one is the loss that got evaporated, so to speak. You cannot recover it. Fine. The second one is the loss that was not evaporated. It was just deformed. You can recover it. It has salvage value. You can see it. Then the loss that also you can see it, but it does not have salvage value. In fact, it has expired, and continuous keeping it will become harmful. So you may need to dispose it. So what do? That disposal cost will now become an additional expense on the company. And so you will have to increase the cost of the process without disposal costs, disposal of normal loss. So disposal of normal loss does not have units here. It's how much you spend in disposing the units. But you will still come here and put your normal loss natural direct. It has no recovery value. But here it has a disposal cost. So you don't go here and put minus 200 here, or neither do you carry this normal loss here. It's just this 200 naira that is the disposable cost. You put it here to increase the costs. And so now the good output is now bearing the increased cost because now there is an increase in the process costs. We now went ahead to talk about abnormal loss. Now, abnormal loss happen to be a loss that you do not expect. The loss that you do not expect. And so because you do not expect it, you did not plan for it. And because you did not plan for it, you are not going to treat it like you treated normal loss. And I said, how will you know you have an abnormal loss? One way to know you have an abnormal loss is that your expected output will be more than your actual output. So because your actual output is smaller than your expected output, it means something is fishy. So how do you treat it? So what we do is that abnormal loss, accounting for abnormal loss, if there is going to be a scrap value, you are going to do it the same way you did normal loss. To calculate the cost of good output, you say total process cost minus the scrap value of the normal loss. And we said that abnormal loss is given the same value as you give to the good production, good output, because you didn't expect it. And so that would mean that someone who is responsible for that department that could not control the abnormal loss may have to pay because you did not expect that kind of loss. So somebody may have to bear the brunt because you're going to value it, or at most the company will suffer it and call it and write it off at the normal price of the good output because you did not expect that normal loss. And I see here that you see the actual output is 1.7, the expected output is 1.8. So you see it is less than normal. So abnormal loss here is 10. And we now said that 2.5 is the cost per liter because we are using total expected output. Never do we use actual output. We are always using expected output to determine our cost per unit, never the actual. So the cost of one good finished output is still 2.5. Okay, now you see it here now. The normal loss does not have a recoverable value. So whether there is a recoverable value or not, abnormal loss should have a recovery value. So you see here now it is reflected in the fact that this is the same amount here. The normal loss has taken its own share, 200, but no recoverable value. Abnormal loss is taking 100 at 2.5. Then the balancing figure is for the actual output, still 2.5. So I believe you understand that. Then we now went ahead to see how the debit and credit will look like. We saw that we're going to debit the abnormal loss account. And the process account, you credit it. So if you see the process account we have been doing here, we credit the abnormal loss. But when you get to the abnormal loss account, you will debit it. So this is an abnormal loss account. So it's coming from process X account, we debit it like this. Now we now said abnormal loss with a recoverable value. How do we treat abnormal loss with a recoverable value? Now, when loss has a scrap value, the value of normal loss is deducted from the process cost as we explained earlier. Normal loss will also have a scrap value, but we said it's going to be treated differently. Sorry, abnormal loss will have a scrap value, but it's going to be treated differently from the way we treat normal loss. Now, we said the cost of expected units of output is going to be calculated in the usual way. The normal expected unit is going to be calculated. All we need to do is look for our input less our normal loss. That would be your expected units. The scrap value of normal loss is normally normal loss in units times the scrap value per unit. That's how we used to find it. Then in the process account, the cost of abnormal loss is measured at the cost of the expected unit as we said before. So nothing changed here. Periodically, the units in the normal loss account are transferred to a scrap account at the scrap value. So you see, when we say normal loss, it doesn't end there. We usually transfer it to a normal loss account, abnormal loss account. Then we still further transfer them, both of them, to what we call a scrap account. So you see, whatever has been captured in the normal loss and abnormal loss gets transferred to the scrap account. Okay, then the balance on the abnormal loss account is an expense for the period measured at the cost of the unit less the scrap value. Fine. That means the scrap value of abnormal loss is set off against the good cost of abnormal loss in the abnormal loss account and not in the process account. We said that all last week. Okay, we now saw an example here where we had an abnormal loss of 10 of 100 liters after we have incurred a normal loss of 200 liters. And we find out that our expected is still 1/8. We are using the 1/8. But you see, we have to still deduct the scrap value of the normal loss to get this total production cost. But this 2.4 is going to be shared by this 1/8. 17 plus 100. That is the normal loss, abnormal loss. So that's how you see it here. 17 times 24, 28 times 24. So everything here is by 240. Normal loss is treated different, like we know, by 0.90. Now, when we prepared the process cost account, we found out that the abnormal loss and normal loss are all here. So all your losses are here. The debit, the credit side. And you see, all losses must carry number of units. All gains, all abnormal gain must carry number of units. All abnormal loss carry number of units. All normal loss will carry number of units. So we usually treat the abnormal loss last under because your normal loss and your output are supposed to be charged the same way. So your output first, Then you remove the abnormal loss, then you get your normal loss, because the normal loss is what you are expecting. Okay, we now did an accounting for normal losses. We now saw the double entry where from process account, we debit the abnormal loss account from the process account, and now we are removing it to take it to a scrap account. And so how do we do it for a scrap account? We'll charge this amount here from the process account with the cost of the good output, which is 240. But because you are selling them for scrap, you cannot sell them at the cost of good output. So you sold all of them for scrap. So when you sold them for scrap, 90 naira as against 240, that means the 150 remaining is going to be written off in the income statement as a loss. It's going to be written off. Okay? Then look at your scrap account. We find out that from process accounts, our normal loss comes straight to scrap account. But our abnormal loss does not come straight to scrap. It has to go to abnormal loss account, then take it to scrap. So your normal loss account, the abnormal loss account from here has been brought. Then how much is the cash that was paid for it? So you see, this is the cash value. Okay, so this is the cash that was received from this scrap. Now we go to abnormal gain. What is abnormal gain? Abnormal gain occurs when the actual loss is more than the expected or normal loss. So abnormal gains occur where the actual loss is less than normal. Abnormal gain is the difference between the normal loss as expected loss and the actual loss. So abnormal gain is expected normal loss minus actual normal loss. So how do you know you have an abnormal gain? How do you know? Is when your actual quantity is higher than your expected quantity. When your actual quantity is higher than the expected, then you have an abnormal gain. Okay? And so because there's an abnormal gain, it goes to the opposite side of the account. It goes to the production cost side. Okay? Accounting for abnormal gain when no scrap value for loss. When there is no scrap value, it means there is no scrap value, no value attached to it. The method of costing for abnormal gain is the same in principle for abnormal loss. If it is assumed that all losses occurred at the end of the process, the cost per unit of finished output and the value of abnormal gain are calculated as the cost per unit expected units of output. So the good output, the value you assign to it is what you can use to assign to abnormal gain. So what you can use to assign to abnormal loss can also be used to assign to abnormal gain. Take note, you cannot have abnormal loss and abnormal gain in the same account. The cost per unit of abnormal loss is therefore the same as the cost of units of goods output. This exactly as before, like we said. Now, differences between costing for abnormal loss and costing for abnormal gains are: abnormal gain is a benefit rather than a cost, whereas abnormal loss is written off as a cost at the end of the financial, increases the profit for the period. abnormal gain is recorded as a debit entry in the process account because it is a benefit. Yes? So you put it in the left-hand side. Okay? The other half of the double entry is recorded in an abnormal gain account. Just like we have an abnormal loss account, we have an abnormal gain account. So when there's an abnormal gain, okay, we enter it in the process account. We said the process account is going to be debited, while in the abnormal gain account is going to be credited. Yes, then at the end of the period is going to be transferred to the P&L. So the transfer is going to increase the profit of the P&L. Now look at an example here. While we were expecting 1,800 units or liters, what came out is 1,850 liters. And you may be wondering, how did it happen? How did it happen? So that is when you are wondering. So we found out that abnormal gain is 50 liters here. So what did we do? Once again, we treated with our expected outputs. We treated with our expected outputs. So what we did was 2.5 is used for everything. So cost of finished goods is supposed to be your output 1,850 times 2.5 as stated here, which gives you 4,625. Now, cost of abnormal gain, that 50 units, you have to still multiply by 2.5 to get 125. Then the normal loss is going to be 0 because there is no scrap value. You had no loss, no normal loss, because your abnormal gain has taken over. Here, 0 because there is no scrap value. You may have a figure, you may have units, but there is no scrap value. So you can see here that there is an abnormal gain. I said it's going to come to the right-hand side, left-hand side, to increase the cost. So it has increased the units by 50, increased here by 150. And so the unit of normal loss was nil. There is no recovery valuable to it. And that would mean that the whole good output went to the value here went to the good output, 4,625. So how do we account for abnormal gain? How do we account for abnormal gain? Look at the ledger entry here. You said the process account is a gain account. So each time you are dealing with profit in the ledger, you credit any profit, you credit your liabilities, you credit your equity, you credit your revenue. Then what do you debit? Assets. You also debit what again? You debit losses. So abnormal gain where loss has a scrap value. What's happening when loss has a scrap value? Where loss has a scrap value, the value of abnormal gain is usually less than the amount shown in the process account. The process has been more efficient and produced more good output, but there is less normal loss units to scrap recovery value. So the scrap recovery value is less than expected. Now, accounting for the scrap value of abnormal gain is similar for scrapping for values accounts, which is a work in progress. Abnormal gain is valued at cost of the expected units of output. The scrap value of normal loss is normal loss times the scrap value per unit as usual. We now say the scrap value of abnormal gain is recorded as a debit entry in the abnormal gain account in a similar way to record the scrap value of abnormal loss as a credit entry abnormal gain. Let's just go straight to this example here. The following quantities relate to production process X. So how do we know we have an abnormal gain? The actual output is more than the expected output. Yes, there's a normal loss, but there's also an abnormal gain. So you cannot have an abnormal gain and abnormal loss. It's impossible. So what do we do? Wow. Okay, so let's go to the process abnormal gain account again. Input quantities is 2,000 liters. Network. Okay, hold on a moment. Let me bring the chat so that I'll be seeing your response. Okay, so we said that how do you know we have an abnormal? How do you know we have an abnormal gain? We have an abnormal gain when our actual output is more than our expected output. But now we said our scrap value of loss is 0.9 per liter. So these 200 losses we make, we are going to be recovering them at 0.29. So as before, these are our production costs. This 36, this 300, and this 600. Now we have to less our recovery from normal loss, scrap value. So we're going to less it, and we have a total production cost to be 4,320. Now we are still using our expected output. Always you divide and you get 2.4. So what do we do? This 2.4 is what will be used to value the abnormal gain and the good output. So we said that is what we did here. Finished goods 2.4, abnormal gain 2.4, normal loss is 0.9 naira. Now look at the process accounts we did again. We said abnormal gain will come to the debit side. So we have our normal 2,000, our abnormal gain is 50, debited in the process account, and the value of 120 is there. Now we go to the normal loss. We use the 180 from normal loss with the 200. So the output becomes the balancing figure. Now, not only is it a balancing figure, it is also the figure that is, we use, sorry, not only is it a balancing figure, it is also the figure that we also use when we are apportioning our good costs. Our good cost with our normal abnormal gain, they are all apportioned the same cost, 2.4, 2.4. So you can actually say 2.4 times this like we did here, to get your values. So you see they're all balanced. So how do we treat the abnormal gain? We said in the abnormal gain account, there's coming from process accounts that's been debited in process accounts. So it's going to be credited in the abnormal gain account. So what happened? Just like we did in abnormal loss, we are still going to sell our abnormal gain, but we are still going to use the scrap account. We're still going to use the scrap account and account for it. So that's what we are going to do. We're going to account for it, and the remaining 75 is going to go into our profit and loss accounts. So I am just wondering, if there's an abnormal gain, it means something is not right. It means too that your expectations too were too low. And if your abnormal gain is still as good as the good output, why should there be a need for scrap? Why should there be a need for you to scrap something that is good? Well, that's some of the weakness of these accounts here. So look at the not scrap account here. Takes from abnormal gain account. It is in the positive side. It is in the credit side. Then look at the process account. It's coming from here. So process account, normal loss. So process account, normal loss is here. Going to the scrap account straight. So you see that your cash that you will receive is going to be abnormal gain plus the value. Okay, that is for 150 for cash. You're going to sell abnormal gain at the scrap value. Then your cash is still also at that scrap value. That's why you are seeing that everything is 18200. So companies are expected to sell 200 liters of scrap products. The abnormal gain means that they only have 150 liters to sell. That is what it means. That normally they are expecting to sell 200 at scrap value, but they only have 150 to sell because of abnormal gain. But now they have costed the abnormal gain at scrap value. This is done in order to account to make the difference equal. Otherwise, I don't see any reason why an abnormal gain that is not deformed. If it was deformed, anyway, it may be a deformed, but it's a gain. Anyway, it's all good. So what are the things that we have learned today? We have been able to see the process costing. We have seen what process costing really is. We have seen the situation where we have abnormal loss, the normal loss, and abnormal loss. Then we also have abnormal gain. Then we have seen how we account for them in the abnormal and normal loss, abnormal loss and abnormal gain account, and also in the scrap account. So that is how we are going to do it. In the next class, we are going to be doing something. We are going to take a complete look at how this process costing is going to end. We are going to look at work in progress, so to speak. I didn't want us to be too fast with this account. I want you to take your time. So we're going to see process costing with closing work in progress, opening work in progress. Then you're going to be seeing something they called weighted average cost method. You're going to be seeing FIFO method, work in progress and losses, joint product and byproduct. So that will be the end of this accounts process costing. Thank you for your patience. Today's class is one of the shortest, and I believe that you will use that to your advantage to see how you can work with all other assignments I've given you and other questions, other classes that I have given you. So, no wahala. Any question you have, feel free to ask. If there is no question, I want to declare the meeting, the class closed. I'm giving you time to ask a question. So if you have any question, send it to the class now. It's okay. So I will now declare the class closed. Thank you so much for your time. Have a nice day.